Welcome to The Explainer. So, today we're diving into a topic that honestly usually makes people incredibly anxious. But you know what? We're going to flip the script entirely. We're looking at the fascinating truth about market collapses and why doing the exact opposite of the crowd can literally change your life forever.
What if the next recession could actually make you wealthy? Now, I know, that sounds totally backwards. We've been conditioned to believe that recessions are just these periods of absolute financial destruction, right? When the headlines flash red and the markets collapse, human instinct kicks in and we just want to panic. Most people sell off everything and try to hide their cash under a mattress. But History tells a very different story. While the masses are panicking, a small, prepared group of investors see a life-changing opportunity.
First things first, we absolutely need to shatter this deeply held myth that recessions simply destroy money. In reality, a recession is just an economic event that doesn't destroy all value, it redistributes it. Literally, it transfers wealth from those who panic right over to those who are positioned correctly. Understanding this one fundamental mindset shift, that is the absolute key to everything we're about to cover today. Okay, let's look at some recent history to actually prove this point, starting with the 2008 financial crisis. I mean, you probably remember the headlines. The housing market completely collapsed. Lehman Brothers, a 158-year-old institution, literally filed for bankruptcy overnight. Unemployment doubled, and the S&P 500 lost over half its value in what was the worst financial panic since the Great Depression. It felt like there was blood in the streets and everyone was terrified. But if you look closer, a second story emerges. Right in the absolute middle of that panic, Warren Buffett wrote an op-ed with a super simple but powerful title, Buy American, I Am. While the general public was selling in absolute terror, Buffett was out there pouring billions of dollars into companies like Goldman Sachs and General Electric. Why would he do that? Well, because he recognized these were incredibly solid companies whose stock prices were just being temporarily crushed by overwhelming fear, not by fundamentally broken business models. And hey, you didn't even have to be a billionaire like Warren Buffett to win here. Everyday investors who simply held their ground, refused to panic, and just kept buying index funds straight through the crash, they saw their investments more than quadruple over the following decade. Think about that. The people who got rich from 2008 weren't necessarily smarter than everyone else. They were simply willing to buy when others were just too afraid. Let's fast forward a bit to March 2020. A global pandemic literally shuts down the world economy in a matter of weeks. The stock market suffers its fastest 30% drop in history. But this time around, the recovery snapped back just as quickly, in this massive V shape. The Nasdaq, which is heavily loaded with tech and e-commerce stocks, didn't just recover, it soared to totally new, unprecedented highs within months. Now, this comparison is absolutely vital. The 2008 crash was fundamentally about taking advantage of widespread, irrational fear. But 2020? That was completely different. It was driven by speed and a massive structural shift in how the world operated. So the lesson in 2020 wasn't just to blindly buy when others are fearful. It was to quickly figure out what parts of the economy were actually breaking, like airlines and cruise lines, which ended up struggling for years, versus what businesses were built for a changing world and were just being dragged down temporarily. Companies like Amazon, Zoom, and Shopify, they exploded as the world adopted practically overnight. So we have two different crashes, two different recoveries, but the exact same underlying truth. Value was redistributed. So, keeping that history in mind, let's look at exactly where these wealthy investors go hunting when the economy takes a hit. We're going to break down the four main areas where real opportunity hides during a downturn. First up, quality stocks at a massive discount. I mean, think about it. Great businesses like Apple or Microsoft, they don't suddenly become terrible companies just because the broader economy enters a recession. They still have incredible products and huge cash reserves. Their shares just become temporarily cheaper because everyone in the market is freaking out at exactly the same time. It's essentially like a flash sale on the world's best companies. Second on our list is real estate. Whenever an economy contracts, you inevitably see distressed sellers and falling property prices. And historically, this creates amazing entry points for investors. But listen, there is a catch here, and it's a pretty big one. This really only works for investors who actually have cash, who have patience, and crucially, who aren't over-leveraged themselves when interest rates or rent markets inevitably shift. If you've got the capital and the stability, a recession is a prime time to buy property. Third, we have dividend-paying companies. We're talking about businesses with incredibly strong, resilient balance sheets. And what's really beautiful about these companies is that they often continue to just pay out cash to their shareholders, even right in the middle of a severe economic downturn. This gives you steady income and directly rewards investors who have the discipline to just stay the course when things start getting rocky. Finally, the fourth area, and honestly, this is probably the most accessible for the everyday investor, is relying on index funds and dollar cost averaging. Look, a lot of people just freeze during a crash because they're terrified of catching a falling knife, right? They think they need to perfectly time the absolute bottom of the market. But guess what? You don't need that impossible skill. You just need to keep buying index funds consistently. By investing the exact same amount on a regular schedule, you are automatically buying more shares when prices are low. It takes the emotion completely out of it. So the crucial point to remember here is this. None of the strategies we just talked about require perfect timing, but they do require something else. And here's the reality check, the part those overnight success stories almost always leave out. Most people who actively try to get rich during a downturn actually end up losing money. Why? Well, because they completely ignore risk management. Panic is not a strategy. Preparation is. The investors who didn't just survive, but actively thrived in 2008 and 2020, they all shared four exact habits. Number one, they kept an emergency fund, which meant they were never forced to sell at the absolute bottom just to cover something like rent. Number two, they avoided excessive debt and leverage, which is the exact thing that wipes out even smart investors during really violent market swings. Number three, they diversified across sectors, asset types, and time. And lastly, they had a solid plan before the crisis hit, not after the panic started. As we wrap up this explainer, I really want you to internalize this idea. Recessions are not rare, apocalyptic anomalies. They are a completely normal, reoccurring chapter in every single economic cycle. The people who build generational wealth from market crashes, they aren't fortune tellers. They don't have some magic crystal ball. They just understand that downturns are inevitable, and they wait patiently with their cash ready and their emotions fully in check. Which leaves us with the absolute most important question for you to answer today. The next downturn will inevitably come. It's basically a mathematical certainty. So when it does, will you be positioned to make a move, or will you be scrambling just to survive? The best time to prepare for the next crisis is always before it starts. If this explainer helped you view market crashes and recessions a little differently, make sure to subscribe so you can keep building that financial preparation. Thanks so much for joining me, and I'll catch you